Friends, you are welcome to my YouTube channel AKD Global Education. Please subscribe this channel. Don't forget to press like button. It will encourage me to make such videos in future. Today I shall discuss on a very important topic, investment ideas. During my discussion, I will cover what do you mean by savings, what are the asset class available for investment, risk, return and liquidity metrics of asset class, concept of total return from asset class, finally, investment philosophy based on total return. What do you mean by savings? It is nothing but excess income available after meeting current expenses. These available savings is to be used for future need to meet financial goals like retirement goal, children education, children's marriage, buying a house, etc. If this fund kept as cash or with savings bank, then real return would be negative due to inflation effect. Then these savings shall seldom be adequate to meet the financial goal. What is to be done then? Savings shall be put into work by investing to earn positive real return. Available funds are to be invested in suitable investment opportunities with an intent of earning a return which shall help to meet the future goals. To earn return, savings to be invested in some asset before putting your hard-earned money into some asset. Let us undertake asset classes. Primarily, they could be classified into two, physical asset and financial asset. With respect to physical assets, they are tangible, means they could be touched. They are typically growth-oriented investment, means bought for appreciation in value rather than income generation. Also, they are seen as hedged hedged against inflation. They could be subclassified as real estate and commodities. Gold and other precious metal and agricultural commodities comes under commodity. With respect to financial asset, they may be structured growth oriented. Appreciation in value is the primary source of income. For example, equity. They may be income oriented. Periodic income like interest is the primary source of income. For example, deposits. They are typically standardized product and controlled by the regulation. Financial assets could be subclassified as cash and cash equivalent, debt and equity. Cash equivalent means deposit in savings. Now I will discuss risk, return and liquidity metrics of asset. With respect to cash, there is a risk of inadequate return because of inflation. With respect to return, they give periodic interest income. They are having low income with low risk profile. With respect to liquidity, they are highly liquid, could be withdrawn any time. With respect to bonds, they are having risk of default. Suppose you have purchased corporate bond, when it got matured, corporate not able to honor the return the amount. With respect to risk of inflation, inadequate return with respect to debt fund. There may be chance of fall in value when interest rate increase. Risk of reinvestment due to fall in interest rate. Suppose your investment got matured, that time interest rate has fallen, so there is a risk of reinvestment due to fall in interest rate. With respect to return, they are having fixed return in the form of coupon rate or interest rate. They gain in value due to fall in interest rate and vice versa. With respect to liquidity, they are low liquid product because they may be locked in for period for early withdrawal, low trading in the stock market. With respect to equity, there is a risk of market risk due to volatility in stock price. Investment for long horizon are considered for equity investment. There may be selection of risks, selecting the right stock. If you select the right stock, you get appreciation. If you select the wrong stock, the value of the share might have decreased like anything. With respect to return, primarily from appreciation in value, you may get dividend if company may or may not declare dividend. Loss in investment will fall in prices. With respect to liquidity, they are highly liquid as listed equity can be easily sold at market price. With respect to real estate, they are there are liquidity risks. Means whenever you want to sell, you may not get customer. Cannot be sold in parts means high ticket value investment. Risk of transparency in pricing and transactions. Suppose you want to buy a house, ask a broker, he will quote for some price. If you want to sell the same product, you will get low price. Managing property and legal issues is another challenging area. Returns impacted by economic cycle. During COVID period, the real estate value was lowered like anything. With respect to return, appreciation in value, you may get rental income. They are seen as hedge against inflation. With respect to liquidity, long and cumbersome process due to lack of transparency in pricing. With respect to gold, there is a risk of volatility in price movement due to speculative forces. With respect to return, only appreciation in value is available. They are seen as hedge against inflation. With respect to liquidity, high in physical gold and gold-linked securities. Now we'll discuss the concept of total return from asset class. Total return of any asset is the summation of periodic income in the form of interest or dividend or rent and appreciation in value or depreciation in value. Total return of financial asset with respect to equity, total return is a combination of periodic and appreciation or depreciation in value. Due to volatility of market price of equity, this total return is volatile. With respect to debt securities, change in price is less frequent and volatile. Total return is less volatile and steady. Now, with respect to earlier discussion, let us revise investment philosophy. Investment portfolio should be a mix of volatile asset class like equity and steady return asset class like debt. First, you have to create emergency of liquid fund. Asset class with low volatility or steady to be earmarked for emergency as liquid fund because you want that fund when the emergencies come within a short notice. Fund amount should be 3 to 6 months of monthly income. Say monthly income is 1 lakh, then liquid fund should be 3 to 6. Then after creating emergencies fund, you have to create long-term fund for retirement goal, children's marriage, children's education, buying a house. For this, you have to earmark a higher weightage of volatile asset class to be considered. Typical rule of asset allocation: equity weightage should be 100 minus age of the investor. Debt weightage should be age of investor. For example, if age of investor is 35 years, then equity investment weightage shall be 65 and of debt shall be 35. As goals comes closer, you have to moderate your investment towards steady returns portfolio. Investors should shift funds from volatile asset class to one with steady return. Weightage of volatile and steady asset class changes with age in favor of asset class. With this, I conclude my today's discussion. Don't forget to subscribe this channel and press like button. Thanks for watching this video.